In this Bridging Commercial Roundtable, in association with Watson Farley and Williams, we will discuss why hybrid products have become so popular in the bridging sector, whether we expect more lenders to offer medium-term money, and how important it is for brokers to help shape new lending products to fill market gaps. Marcus Dissard, Director of Sales at Castle Trust, and Andy Reid, Director, Intermediary and Network at Obelix Capital, will be joined by Ranjiv Kumar, Partner at Watson Farley and Williams. Also in attendance is Lucy Barrett, Managing Director, Advantage Finance, Danny Robinson, Director of Commercial at Gray Matters Specialist Lending, and Sam O'Neill, Senior Finance Broker at Clifton Private Finance.
I think hybrid products are becoming more popular because people need flexibility. The market conditions that we're in at the moment are very sort of diverse, and people are looking for different ways of being able to borrow money. So you can have a hybrid of servicing a loan, rolling a loan up, and it just keeps the cost of funds down for their sort of monthly cash flow. But I think that's why there's a lot of demand for this type of products, therefore the supply will be more and more for lenders going forward.
I would argue though that hybrids is a loose term used within the industry. Such things as hybrid bridging, does it really exist? There are the likes of Castle Trust that do if you like, two elements of a loan that make it hybrid, but barring that, most lenders, Andy would agree as well, already offer that type of facility to their clients and their brokers without actually calling it hybrid, if you like.
Right.
You have to become a bit more creative, and let's be honest, there's so many lenders in the short-term bridging space that you have to be a bit different to be able to win that business, and at the same time, you know, keep your brokers happy. They're the ones that give us the business, so we need to make sure that their client has the right solution and that we try and accommodate all of those things they're looking for.
The issue, I think, with hybrid products, flexibility should just come as standard to any bridging lender. Fundamentally, that's what it is. And are you diluting your brand, your ethos of what you're offering? If you're saying we'll take a view on everything and anything, you do need parameters and say, look, we're able to move and be flexible within these parameters, but you still need an identity of what you're looking to do and what ultimately the customer's getting as well.
I think it's just starting with a piece of paper and saying to the customer, tell me what the next 12, 18 months looks like, what's important to you, sort of how have you got to where you are now, and what, to the best possible your knowledge, is that how's that going to unfold over the next 12, 18 months, because until you understand really what the problem is, it's impossible to find the solution. So it's not a case of, right, this customer needs a bridge, let's go and get a bridge. It's a case of understanding what they need to do and how they need to do it.
What we do like and look for is a broker who understands the bridging market. There is that kind of feeling out there that bridging is so simple and you can just affect one with a lender and there's plenty to choose from. But it's really understanding what the client wants and how you can address that by choosing the right lender.
How difficult is that for you guys as brokers to try and educate clients that it's not always about the rate?
It depends on the experience of the customer, I think. If you've got a customer that borrows a lot, they tend to know that. The conversation's easier. Sometimes when they're slightly newer to it, they come to you and they say, oh, well, you know, Bank of England base rate's 0.75. What? And you're like, this is going to be a tough start.
Yeah.
Hybrid products have been around for ages. If we have a look at term sheets, there's always some element of creativity in a term sheet. We can tell what the lender's trying to achieve, whether it's a combination of, in the wider world, you know, debt and equity, or equity-esque product, or refurb to BTL, or bridge to medium-term loan, and so on. So we can always see where there is that element of complexity. I think actually this goes back to Lucy's original point about borrowers being certain in terms of what they want, because they'll want to know where the breaks are, when they can repay, when the loan flips onto another form of loan, and so on. And so that's the added complexity in documents.
As a lender, we'll see the same deal from different brokers 2 or 3 times. We'll see it come in, we'll price it for the risk that we're willing to take. And I can count on so many, like how many times that deal will come back in 3 weeks and I'll be like, okay, actually your one is the best one because of the flexibility. It's not just about the price, because they then work out what it is they actually need in general.
As brokers, do you feel that you want to work with lenders that offer kind of the whole piece then? Is that more of a preference?
It's an incentive for sure, because you can build a wider relationship. It doesn't mean that you would avoid lenders where you can't work with other products, but I think it certainly helps.
We have lots of brokers that come to us and they'll do 3 or 4 cases a year, say, and it might be on one particular product, and then they realise, actually, you can do the land, and then you can spin it into a dev, and then you can do the dev exit, and you can just have the whole thing with one lender. Whereas that's become more and more as we've got older as a business. But initially, it's the same with you, isn't it? We were talking about that before, and now all of a sudden you have, oh, okay, well, we can do the whole process there. And if you make it as seamless as you can and as a pleasurable journey for the client, then it works.
Yeah, it's almost as though it used to be sort of a sidebar arrangement, and now it's actually more mainstream.
It's been pigeonholed now to be what it is.
I think that goes back again to knowing the client day one, especially from a broker's point of view, that Mr. and Mrs. Jones have got a chain break. They only need it for a couple of months, and then there's no need to look at someone who's going to offer everything under the sun. If someone's saying, I'm going to do a bit of refurb, I might sell it, I might keep it, I might do this, I might do that, then obviously you need to look at something a bit more all-encompassing.
It's important as well, the transparency of how that loan has been put together, because you kind of have 3 stages. So the broker will explain it to them and go through how they think they've understood the requirements and how they propose putting the deal together. And then the next thing is the lender documentation, and then obviously it hits the legal advisors, and it's making sure that, I mean, we do have situations where you're talking to a customer, you're explaining it to them, and you wonder if they're just in a rush and they're not taking it all in, and you have to keep bringing them back, because the last thing that you want is for it to get into legals, you to issue the docs and them to say, hang on a minute, my lawyers told me that I need to have this repaid back by month 3, otherwise the rate goes up. I didn't know that. And it's on every piece of documentation that you've ever issued, it's in every conversation, but I think it's that blinkered view of, right, well, I'm going to be out of it in 3 months, so my rate is 0.75.
It's an interesting point, because obviously there's a whole variance of knowledge in the broker market, isn't there? And sometimes I'm having conversations with brokers say, this is a DevX, it's 6 months. I go, okay, is it though? Is that property going to go in 6 months? Yep, definitely. The problem you've got is, of course, and you have to explain this, is why don't you take a longer term? Because if you pay it down early, there's no penalty. You only get one chance at extending, and if you extend it and it still doesn't sell, guess what? So go for 12, and God forbid it's not gone in 12, then you can extend it. But they won't understand all the one-time charges and everything else, otherwise they're going to default, which no lender wants a client to go into default. But it's that kind of education, isn't it, of the brokers understanding that.
We just simply won't do it. If someone comes to us with a case and they say, look, we're going to sell this in 12 months, and we look at it and think, well, that's a 12-month problem for us, because we know at that point we're going to be the ones that have the problem. So we will just simply say, no, this doesn't work for us. This is how it would work for us, and it's a take it or leave it at that point. Like I say, we're all in the market, we're all fighting for business, but there is so much to go around that we don't have to say yes to everything.
Who's dictating the term lending? Is it the people that are funding these lenders? Are they saying, we want you to go into term, or is it the demands?
That's again, but opportunity versus necessity thing, isn't it? We got an opportunity because we like the look of this USP, we're going to go for it, or necessity, exactly like you said, we got a pool full of money, we got to get rid of it. That's dangerous territory then. Because you're going into something completely unknown. You don't know what you're doing.
Your risk attitude dips down, doesn't it?
Yeah, but margins also are false necessity in some respect, because they're getting so low. It's like, well, I've got to branch out to a volume-based thing to actually make some money.
We say to our lender clients, whether they are bridge lenders or alternative financial institutions, USP houses or whatever, we say, let us have a look at the term sheet. Let us have an early look at the term sheet before it goes out, before it's signed, because we will add some value to it. And we do that regardless of whether or not we're instructed on the deal, because the more detailed and informative the term sheet can be, the easier it is then to paper the loan.
Thank you so much for watching our latest filmed roundtable event. If you would like to take part or even sponsor one of our next events, then please do get in touch at beth@medianet.co.uk. All the information will be included in the video. We have roundtable events in 2020. We have them in February, April, September and October. So if you want to take part, let me know.